Welcome to A Coleman Conversation. I'm talking with Jon Winick, CEO, Clark Street Capital, the expert in transferring portfolios from one bank balance sheet to another. How'd I do with that, Jon?
You did great. Excellent.
What do you do? Be more specific. What do you do for the industry?
So, to put it real bluntly, we sell loans. We sell portfolios of loans. And one thing I particularly enjoy is the broad coverage of the entire credit space. So, on one day I'm working on, a clean performing residential mortgage pool, CRE multifamily to, a distressed disaster. So, we really get to see almost anything in the credit space. And it's fun that, every year we learn a new expertise. For example, I have not been to Puerto Rico as an adult, still haven't gone. I probably should go. But we're now the experts in selling legacy CRE loans in Puerto Rico. So we're constantly adding to our skill set. Our clients love us. We have the highest satisfaction rate in the industry. I don't have a single client that has used us and not used us again. And only one has used someone else, and they used us on their last deal. So obviously, you could always use more clients, but very happy with our business.
Well, that's supposed to be my job. See, those are my notes to say I'm supposed to sing your praises, and then you go, well, thanks, Bob. I'm being humble.
Well,
But Jon is absolutely correct. Great reputation, and does a very vital service. How'd you end up doing this for a living?
My success story, I think, is always kind of interesting. But one of the advice I always give to young people is if you show up and you do what you say you're going to do and you're on time, you're going to be ahead of 95% of your competition.
Wait a minute. Show up on time and do what you say you're going to do. That's your secret to success.
I think it sounds very simple, but how many people actually do it? It's actually worse with the advent of cell phones. People are far more likely to flake out and not show up to things, post the advent of the smartphone. But to that point, I was somewhat miserable working for GE Capital in St. Louis. Okay. I was essentially a glorified telemarketer. And I had a friend who was in town. We proceeded to stay out all night. I was pretty intoxicated in the morning, or hungover. And he wanted to continue the party and, let's go to Memphis. Let's keep going. Don't go to work today. It was a Friday. And I took a shower and something came over me in the shower where I was like, you know what? I got to go to work today. I don't know why. I got to go to work today. So I show up and someone in our group who was the number one performer inexplicably got fired. I still to this day don't know what Stan did, but he was fired. And I got a call, and I guess I was the next person up to be put on a project in which we would sell or broker loans that GE Capital at the time wouldn't do. And, at the time we had probably the best nationwide sales force of BDOs. And we kept seeing, Borrego Springs Bank did this deal and we didn't do it. Or Community West Bank did this deal and we wouldn't do it. And, a light bulb went off where it's like, well, if we could collect a point on every deal that we don't do, or 2 points, that'd be a pretty good business. And so I was put on this project. My boss at the time, Jeff Witorsky, had some sort of trip he was going on. So I babysitted this project for 2 weeks. And by the time he came back, I'd created a whole business and created a whole career. And it's funny, when he interviewed me, I could barely stay awake during the meeting. I mean, I must have been on, 4 cups of coffee, Red Bull, and so on. And, I made it through the meeting and, it worked out. And it's been my career ever since. I've essentially been in the business of buying and selling loans for my entire adult life. I've also done some interesting things kind of somewhat related to that. I do have a small private equity fund, a couple of private equity funds that have done well, and I don't talk much about that. And I was in and out of the student housing business as well. So I also do some interesting stuff, but my primary business is I sell loans.
One of the interesting things you do is you have a chess rating of what level are you, Jon?
Yeah, I'm like, I think my current rating on chess.com I was up to over 2000, but I'm like 1850, 1900. My USCF rating is probably a little lower than that right now. But I do love chess. Two of my leisurely passions are golf and chess. And I regret not doing any of those things as a child because it is so much harder to be good at them when you start as an adult.
What does I got to interrupt. What does an 1850 rating mean in chess?
So I would be like an expert would probably start at 2000. So I guess I would say I'm a near expert. A master typically starts at 2200.
All right.
And the best player in the world is probably pushing 2900.
So you have a way to go.
I got a way to go, but it's limitless, the knowledge, and people collectively keep getting better at chess. So just to maintain your rating takes some work. And I'm more play chess for fun. I play a lot of 3-minute games.
Good for you.
Those are fun. But
where'd you go to school?
I went to the greatest university in the world, the University of Michigan in Ann Arbor. I was a history major. What?
Go blue.
Yeah, I was a history major. I got my MBA at WashU in St. Louis.
I didn't know you were a history major. You and I have that in common. What area of history did you enjoy the most?
I would say like the Cold War period. I think that the tension, and there's probably a chess parallel there, where, we were basically at the brink of world destruction for so long. And fortunately, cooler heads prevail during that.
Very good. Very good. Fascinating. And you and I, similar, that I went and got my MBA at USC, by the way. Tell me more about, let's talk about your business. Tell me exactly how a transaction works.
Sure. One of the things that when you look at the loan sales space, and I think you can look at broader, really with all assets, is essentially there's 2 ways to sell assets, basically. There's a listing and there's an auction.
Let me stop you there. Why would a bank want to sell an asset?
Sure. First off, a loan is an illiquid asset, right? And I guess they can borrow against it through FHLB or pledge assets to the Fed, but it's not a liquid asset, right? I mean, you can't monetize it like you could a bond that you have in your portfolio where you could clear in a couple days. But it's an illiquid asset, and banks sell loans for a variety of reasons. In a lot of cases, it's to generate premium income and fee income. The entire mortgage origination business is all based on an originate to sell model, right? So every bank that makes a residential mortgage loan sells loans. And then there are other reasons. We have too much exposure in senior housing. We have too much hospitality. We have too much specific borrower. Our new chief credit officer doesn't like the gun industry, whatever. There's always a reason in which somebody may want to sell a portfolio or loan. I like to joke that no one ever admits that they sell loans. So I obviously understand the sophistication there that, they don't often admit to it. And I think in our discrete process, we respect that. And for example, we never advertise who our seller is.
Right.
The only people who know who the seller is have signed NDA and they're qualified. But yes, banks sell loans for a variety of reasons. Everybody of a certain size does it.
Let me flip the question now. Who buys this? What type of institution buys these portfolios?
Yeah, and that's part of the fun part of it is, if it's a clean performing loan, the buyers are going to be depository institutions, banks, credit unions, in some cases, insurance companies, or securitized lenders, people that are aggregating assets for securitizations. If they're distressed, and of course, distress is so broadly defined. Most distressed loans are current, but the buyer is not going to be another financial institution because there's more embedded risk there. So that would be a different set of buyers. But it gets pretty granular. Like, for example, we've done pools of very unique niches from churches, and we know the groups that buy churches, and that's extremely difficult. That might be the most difficult.
Really?
Lending type.
It makes sense, but yeah.
So many people have pulled back from church lending. Bank of the West, for example, used to be active in that space, and that hasn't really continued with their acquisition. So yeah, it depends. The short answer is it depends. We run a process where, we have every single bank, every single credit union. We publish that band report every Thursday. 55,000 or so people get it. I guess on a weekly basis, 15,000 people read it. And so, we do a great job at getting the word out on our offerings.
And I want to talk about what you do for marketing. You do two unique things. First of all, the band report, and band stands for
Bank Asset Network.
There you go. I like that. But Jon, you and I have been collaborating. I shouldn't say collaborating. I've just been introducing it. And for those of you who want to know what's going on in banking, Jon moderates a host of webinars about every 2 or 3 months talking about banking and what's going on. Jon, you get a great group of panelists. It's a great discussion, and I would highly encourage everyone to listen to what Jon says. Yesterday, we were talking about in your quarterly webinar about banks, and you always talk about third quarter results and whatever. So my follow-up question to you is, looking forward in 2026, and you have many years of experience dealing with the Great Recession and COVID and whatever. What's your outlook for 2026? Are you positive? Are you leery? What are your thoughts?
I'm bearish.
Good. I love it.
Listen, I don't think the American public, the investing public, or really anyone, or very few people understand how much COVID stimulus hit a lot of problems.
I'm going to interrupt you because you're the only person who's banging that drum, and you and I talked to a lot of people, but that's been one of your big analysis. And by the way, Jon in that band report, he does a great analysis of his personal take on the market. And I think you have a deeper insight on this than most other people. So please expand on that.
Yeah, no, I appreciate that. So you had generational level of stimulus, and when you ask a small business owner, how are you doing in, say, 2021, it's, I'm doing great.
I got PPP loan.
My student loan payment, I haven't had to make a payment on that for a while. They left me alone. My bank just gave me a 12-month forbearance, no payments, no interest. I got this PPP loan. So I'm getting $1 million from the government, which I'm supposed to use for payroll, but I probably won't.
Wink, wink.
oh, I got the CIDL loan at 3.75%, and I don't have to deal with that for like 30 months. So, we're good there. So, all this money turned somebody who might have been struggling into doing great. And, that's not something that the US government can sustain indefinitely. And I don't think people understand how much of that COVID stimulus is still out there. For example, the government, although this program is supposed to end, has made hundreds of thousands of mortgage payments to borrowers who can't pay their mortgage, and has kept as many as 5 million homes out of foreclosure. There stuff like that persisted for so long and is either done with or going away shortly. And you're going from the most stimulated environment in history to a negative stimulus environment.
So why are you bearish?
So I think the credit problems were covered up through this money. This money is sort of dried up. I think the lower middle income consumer is really struggling. I think home affordability is the worst it's ever been in our nation's history. Orange County, for example, not far from where you are, average income 111,000, average home price $1.2 million. 10 times home prices to medium income is completely unsustainable, and a normal market is 3 to 5 times. So our housing market is out of control, and the home builders are struggling. So I see a lot of headwinds. AI offers lots of promise. We're actually working on something in that arena, which we can't really talk about. But the AI spending seems to be propping up the entire economy, certainly the stock market, and you just wonder how long that's going to continue. And you're seeing some real cracks in auto. There was another bankruptcy of a subprime lender today. We're definitely seeing some cracks emerge.
How does that affect the regional and community bank?
Directly and indirectly. One thing I'd point out is, NDFI lending gets a lot of scrutiny, and perhaps it should be, but it's private credit that's going to take the hits on these deals, not the banks that lend to them.
Okay.
Now, fraud, all bets are off when there's fraud, but banks that lend to private credit are typically lending 75 to 80 cents on the dollar. So if you've got a private credit lender that does bridge loans at 80% LTV and you're lending 75%, you're effectively at 60% on a pool of assets. So you wouldn't take a loss unless the entire private credit investment was wiped out. So, the private credits, it's very interesting, but it is exploded. Someone told me there were more private PE firms than McDonald's.
I would have lost that bet.
Yeah. So I do see some real problems in private credit. It's going to hurt regional banks that lend to them. It's going to result in more painful resolutions of assets, because private credit was bailing a lot of banks out on deals that weren't that good. So, look, the banks have done well. Credit's held up. Earnings continue to be very strong. The largest 4 banks, I can't remember a time when they crushed it on earnings.
That's right.
Crushed it on revenue, raised their guidance. But there are definitely these troubling signs. And look, we should grab your popcorn and see what happens. I don't like to predict doom and gloom. I like to point out, here are the risks.
Yeah, you're a positive guy. That's why I was shocked that you said that. You're normally a positive guy on that.
Yeah, I've turned bearish recently. Yes.
Tell me about specifically. Let's tie you back to Clark Street Capital, and we'll end with that. Tell me how you have specific products that enable lenders to manage their portfolio, especially if they're buying into your bearish outlook. Tell me what you can do specifically for them. I believe you have something called, what is it, an accelerated band program? Tell me about that.
Yeah. So I'll talk about the accelerated band program for a minute. So, banks, community banks in particular, and larger banks as well, sometimes have small portfolios or single relationships they want to shed. Our threshold for the accelerated band is 5 million or less. And, we run a more expedited process versus our normal process. And, as a success story, we closed last Tuesday on a $3 million hotel pool. It was just 2 assets. And we had 10, 11 bids, 22, 23 NDAs. And from start to finish, the whole process was 13 business days. So, sometimes banks get to the end of the quarter and they want to move quickly. And so that's not a normal process, but it's a way to accommodate smaller deals.
Can you give me the difference between your normal sale process of transferring portfolios from one institution to another, or you have an accelerated band program? Tell me about that unique service that you offer.
Yeah. So our normal process is designed for portfolios and some larger one-off deals. Typically, from start to finish, that's a 6 to 10 week process. We expose the asset to a very large audience. We're typically getting, at least 100 plus NDAs. There's sometimes a more leisurely process in getting people the information. We might launch without the loan files. We might not get the asset summary reports and memos until 10 days before bids and so on. And that's our typical process. We do a negotiated sale where we do a launch date, an indicative bid date, and then we either negotiate with a party or parties, or we go to a final bid. We like the negotiated sale because we think it's the best of both worlds. The FDIC likes this single round of bids, which we think depresses prices. And bank buyers, they like a negotiated process. They like that they can submit an indicative bid. And we can always go to a final bid, and we sometimes do, but it gives us the flexibility. Now, the accelerated program, when you have, say, I'll use this example from earlier, when you have a $3 million pool of loans on 2 hotels in rural Wyoming, it's not something that an email blast to the world. We'll certainly get a lot of interest in it, but you almost have to bribe people to look at smaller deals.
Market it. You have to market it. Yeah.
Yeah. It kind of works against you, where it's like, well, everyone's looking at this deal and it's kind of small. Why do I want to look at it? On the accelerated band program, our bid date is usually 7 business days after launch. So very quick process. We launch on a Thursday. Indicative bids are the following Tuesday. So not the following week, but the following Tuesday. And the buyers love it because they know it's a smaller group. It's only going to professionals. We're not selling to somebody who's never bought a loan before. And they like that they can underwrite a loan today and own it in 2 weeks. And, there's that element of impulse buying that is obvious in retail that's appealing. And the audience is a lot smaller. We're not going to get 125 NDAs. We'll probably get like 10. We're not going to get the same number of bids. We'll probably get, 5 or so instead of 15 or so. But ultimately, it's a great way for smaller deals, and it moves very fast.
Jon, do me a favor. So give me an estimated time frame. How many days does the normal process take from beginning to close, and how many days would the accelerated process take?
Yeah, so let's just use October 1st, just so we start with a clean month. Let's say we launched the deal through our normal process October 1st. Our indicative bid date would probably be about 3 weeks later. So say October
Okay.
22nd.
I didn't
and
realize it was-
apologize, that's like a Saturday or something.
Yeah, but I didn't realize. I was shocked by that because I didn't realize it was that long of a
Yeah,
marketing.
well, because you have to, we get very high quality indicatives, and people have done
Okay, so
their
they're going to go.
homework.
They're do
And
their due
in
diligence.
a lot of
Okay.
cases, they visited the assets.
Okay.
They've done
All right.
90% of their due diligence. So you need a little bit of time. You also need to market it, right? We need to pick up the phone. We need to call people. We need to say, hey, you've got a loan to this borrower. Are you interested in this portfolio, and so on. So you need a little bit of time. And then typically we get the bids on a Tuesday or Thursday. We get back to people the following Monday. And closing would probably be 3 weeks later.
Oh, really?
It might be
Okay.
shorter if we pick a horse right away. The accelerated program is a 2 to 3 week process. So
So
6 to
about
10 weeks versus 2 to 3.
Oh, very good. Well, that puts it into context. And your trading outlook for, let's finish up with this. Your trading outlook on moving portfolios in 2026. Any deviation on that, or business as usual?
No, I mean, pricing is very good. There's a lot of money out there chasing too few opportunities. As it relates to kind of your world, we actually just are looking at a couple SBA 504 deals, but premiums kind of tap out. I don't know exactly what the number is, but a lot of these deals trade at a 102 to 104 type range. I don't care if your model says that asset's worth 108. It's very difficult to get someone to pay that. The secondary market for 504, the official secondary market, is very small, and encompasses
that's
10%
of the market. Yeah,
10% of all 504s. Like if it's not very efficient, and sure, you could sell 2 loans for 108, but if you've got 20 loans to sell, you're probably better off selling 20 loans for 102, 103, and being stuck with the other 18. So anyway, I'm optimistic because there's a lot of money out there. I always think a trigger is a good thing. I mean, I might be personally bearish on things, but I just need one person with a positive view on an asset to facilitate a trade.
Very good, John. CEO, Clark Street Capital, thank you for the Coleman Conversation.
Absolutely. Thank you, Bob. Anytime. Always love chatting with you.